Hello friends, this is Shridhar Paidichetty here, and today I'm going to talk about a chronic problem in the Indian banking industry, non-performing assets. In the Financial Stability Report issued in the month of June 2016, the Reserve Bank of India projected gross non-performing assets across the public sector and banks at 8.5% of their asset base by the end of March 2017. This itself is a very disturbing piece of information. To know more about non-performing assets and why they are gaining this kind of attention, let's look at the recent history. The outgoing head of the Reserve Bank of India, the Governor, Raghuram Rajan, would be remembered for two broad actions which he had initiated during his tenure. One was his persistence in taming the inflation, where there were different opinions about this whole approach. The second one being cleaning up the bank's assets, which is books of accounts in the public sector banks. Now, before I talk more about what this all means, let me first take you through what an NPA is. Non-performing asset is one of the asset categories in a particular bank. Now, banks' assets can be broadly categorized into standard assets and non-performing assets. Non-performing assets have three categories: substandard, doubtful, and loss. If a particular customer is not servicing his debt in terms of repayment of principal as well as interest for over 90 days from the due date, then it becomes a substandard asset. And as long as this due amount is outstanding less than 12 months, it remains a substandard asset. When this asset category turns 12 months old, then it gets reclassified as doubtful asset. And when the probability of recovering these assets becomes absolutely zero, then these have to be written off. Now, there are different guidelines issued by the Reserve Bank of India to provide for these asset categories, basically setting aside capital in anticipation of any contingency which can come in the future. Even for standard assets, there are guidelines to set aside 0.4% of the asset value in terms of making provisions. When it comes to substandard assets, banks are required to provide for 10% of the asset base, which is classified as substandard. The provisioning value varies as the asset quality deteriorates. So for doubtful assets, the provisioning could vary from 20% to 50% to close to 100%. For loss assets, the banks are expected to write off the entire amount. So these provisions, these rules, these regulations have been existing for long. So what has changed? RBI, or the Reserve Bank of India, had conducted asset quality review of the public sector banks, and it noticed that a lot of these assets, which was shown as standard assets, were basically restructured loans being passed off as standard assets. And Reserve Bank of India did not budge from its position and insisted that these assets should be classified as non-performing assets. That's why we see more and more public sector banks, when they are coming out with their quarterly results, announcing huge amount of non-performing assets in their books. So it's not that the problem didn't exist in the past. It's just that banks are coming out of the closet and markets are viewing it positively. Now, what are the factors which lead to these non-performing assets? There are external factors and there are internal factors. If I can talk about some of the external factors, let me go one by one. Natural calamities, things like drought. The poor farmer has very little to fend for himself. How would he expect to repay the loans? So when the natural calamities happen, some of the agri loans turn bad. Similarly, due to improper project handling or poor technology, some of the industrial projects also might go wrong and the industries are not able to service their liabilities. Industrial sickness is another reason why we have non-performing assets. Then there is a category called willful defaults. Now, of late you must be hearing about industrialists who have the capability but have refused to make good their obligations, and in a brazen way, and they have the funds to fight long legal battles with the banks, and the pace of judiciary assists in these delays. The fourth one being lack of demand or fall in demand. Sudden economic circumstances which undergo changes can also lead to production being there, but then the work capital cycle not getting completed. Either sales are not happening or debtors are unable to repay their liabilities, and hence these corporates, these companies are unable to pay the banks. Another reason could be change in government policies. Now we do hear about instances like ban of diesel vehicles in a particular region, say for example Delhi NCR region. This is out of the blue. Supreme Court has passed an order and all automobile companies are reeling under pressure. Was it predicted? No. But then there is an impact. While big corporates might have the financial strength, the smaller auto ancillary companies and other intermediaries might face financial stress, and they form the SME, small and medium enterprises segment, which can cause huge non-performing assets in the banks. Similarly, if new environment laws come in which disallow construction in certain regions, which might come under coastal regulation zones or something of that sort, then again if builders who have invested heavily into procurement of land and they have semi-finished projects, they are also unable to repay their liabilities. So change in the government regulations can also assist in increasing the non-performing assets in the banks. The next one is quite interesting. The directed loan system. Now, government has got priority sector lending, where public sector banks are mandated to lend close to 40% of their assets into the priority sector. And this sector has seen huge NPAs. But then we have seen a history of loan melas, loan waivers, government after government. The vote bank politics prevails over banking sense. And finally, ineffective recovery tribunals. Now, tribunals which are not able to do justice help the banks in recovering their loans are not helping the entire country in any manner. Now, these are some of the external factors. What are the internal factors? There are quite a few. The whole lending process could be a defective one. The principles of safety, liquidity, and profitability might have been ignored. Or, while doing the credit appraisal, inappropriate MIS or technology has been used, which could lead to wrong decision making. There could be managerial deficiencies where not enough focus has been provided to risk diversification, which also can lead to single sector exposure in a bank. And if that particular sector is not doing well, the bank can go down. And then finally, the practice of bankers visiting their clients, interacting with them, looking at the external environment and how the market forces are playing and how it can impact their future revenue. That is something a lot needs to be done. I hope some of these points were useful and it made sense to you. I look forward to your feedback. Thank you for your patient listening.